Confident Real Estate is what you're watching. I'm your host, JC, and hopefully this video will save you from a disaster. Today, we're going to review 5 types of properties that often trick new investors and even some seasoned ones who really should know better. I really want you to digest what we're going to cover in this video today because some of these sneaky properties are not easy to spot. So stay focused, stay with me to the end, and let's get into it. But first, I want you to please hit that like button down below because that helps me grow the channel so I can continue to share my insight, information, and tactics on real estate investing with you and many others who have yet to somehow discover this great channel, like you did. Thank you very much. All right, let's get into it. The first of these properties that we're going to review are the properties that fall into the amazing but misleading cash flow category. These are properties where the seller, as the landlord, is giving you a rent roll that seems incredible, above market rents, but the rents are inflated, they're misleading. Perhaps the landlord enticed tenants to move into the property by giving them 1 month of free rent up front and 1 month of free rent at the end of their lease, or maybe the first 2 months were free and then the last 10 months were where the tenant paid at a higher than market value. But when you spread that total for the year over 12 months, it's slightly lower than market, which is why the tenant was enticed to come in. Now you're looking at the rent roll saying, wow, they're getting how much per month? But it's inflated because they were really only getting that over 10 months, not over 12 months. And you're going to have a hard time getting that rent when the tenant moves out. Or you may find out that you owe the tenant a break on the rent in the last month of the lease. So that's why you always do your due diligence and read the leases. The other reason the cash flow may look amazing is because the expenses are underrepresented. They're not accurate. You have to do your due diligence. So what we typically do is we ask that the seller make some representations in the contract. We want them to attach a certified rent roll that certifies they are collecting X amount of rent every month from the tenants, and they're going to certify it as of the date of the contract and again at the closing table. And that certification is going to survive beyond the closing so that you're covered if you find out that they've been misleading you and you entered into a deal based on misleading, misrepresented information. You're also going to ask that they attach a list of service contracts to the contract as well. And then you're going to go do your due diligence and make sure that you read the leases, read the service contracts, understand the expenses, and that you're confident in what you're actually buying. But again, don't take the seller at their word for what the cash flow is. Ever. You got to do your own due diligence. And if you want to learn more about how you can actually ask the seller to make representations in the contract as to the leases and the service contracts, then you better click the video down below that we did, which was a long video, but very good video, in my biased opinion, on seller representations in contracts and how to make the seller put their money where their mouth is. Next up are Class D properties, and these typically fall into one of 2 categories. The first category is the management nightmare that may also come with rent regulations. A lot of Class D properties, depending on the area where you are, you can find a property that looks like an amazing steal of a deal based on what the purchase price is, what they're asking for, and how many units you're going to get for that price. But rent regulations, based on the jurisdiction you're in, may be tied to the property, meaning you cannot raise the rents on a number of the units within the property above a certain threshold because they're low and middle income housing for that neighborhood. So that means if you have capital improvement projects or updates to mechanicals that need to be made, it's hard to cover those costs because you're not going to be able to raise the rents to get market rent to cover them. So you're literally putting money into the property to keep it salvageable and operating and functional, but at the same time, you're not going to see any of that money coming back to you in the form of rents and cash flow because you cannot raise the rents above a certain threshold. And let's be clear, a lot of times, these tenants are nightmares. Not all the time, but I'll be honest with you. Here in my experience in the Northeast, a lot of times the low and middle income tenants can be very problematic to deal with, and your management expenses go up, your property maintenance and repair expenses go up, and you're not going to see the cash flow back to justify what you're putting into the property. It's just a very hard economic deal. And if you're not familiar with it, you should not get involved in rent regulated properties at all whatsoever. They are heavily regulated. And again, let's be clear, these properties are not in good condition when you buy them. They are not Class A newly built properties. They are typically older properties that need a lot of maintenance, a lot of updates, and do not have a lot of cash flow.
A couple of years ago, somebody tried to sell me this property right behind me as an incredible deal.
It was a good sized building. It had a good number of units in it, but as we came to quickly find out, there were rent regulation issues. It was in need of massive upgrades. And unless you really came to tour the property and get familiar with it, you probably wouldn't notice that it's so close to transportation. 2 train lines run directly behind the building. Nobody wants to look out the window and look at 2 train lines going by 24 hours a day. The second type of Class D property are those that have either physical or title issues, meaning they look wonderful, but some real preliminary or detailed inspections are going to show you that they have structural issues, mechanical issues, plumbing issues, electrical issues, possibly foundation issues. Or you're going to go do a title search and you're going to come back with issues of chain of title defects, which typically happens when a property is inherited or transferred through estates or wills and probate issues, and families may be fighting about them. There may be pending litigation attached to the property. And at that point, you're really going to have to evaluate, one, whether or not you even want to buy the property and take on those headaches, and two, at what price do those headaches hurt a little less? Maybe not the asking price that the seller is looking for, but that's room for negotiation. Just be aware of it and understand what your appetite is for it and what you're getting into if there are inspection issues or title issues. It's because of these issues that the price per square foot is typically a lot lower than the rest of the market, and why so many new investors get sucked in to what they will later find out are management nightmares and complete money pits. And this is also a good lesson for why you go and get title searches and title insurance on any and every property you buy. And I know there are some of you out there who are going to say, perhaps in the comments below, that you never get title insurance and it's a waste of money. That is playing Russian roulette with your portfolio. I would never advise one of my clients as an attorney, and I would never myself buy a property that didn't have full insurance on the title. Playing Russian roulette, the longer you go on, at some point your luck will run out and you will lose, and your portfolio may never recover from it. Not worth it. The next deal to watch out for is the misleading valuations deal. And again, that can be broken down into 2 subsectors. The first is where the seller tells you, hey, listen, you're getting a great deal because, let's face it, my rents are below market. You could come in, raise the rent roll on day one, and you're going to make more money. And that may be true, but the market value rents are still going to take some extra work on your part. So the purchase price may be below market, but it still may be higher than what the current rent roll demands of it, because you're going to have to come in and get those rents to the market value, which means either negotiating with the current tenants to get them to a market rate rent, or potentially getting rid of them and going to find new tenants and then go through the credit check and everything else and bring them in. And you may need to do some base renovations to the actual units in order to really bring them to the level that's going to demand market rate rents. So don't fall for it when you hear the rents are lower than market and you can raise them day one, because that typically is not true. That said, you may still want to pursue the deal, but just see it for what it is. Do your due diligence, crunch your numbers, do your comps as to what the current value is, what the after repair value can be, what the rents should be right now based on the condition of the property, and what the rents may be worth a little higher, hopefully, after you've done some basic renovations. Always crunch your numbers. The second type of misleading valuation property isn't really the seller misleading you, it's you misleading yourself because it is a turnkey property and you have fallen emotionally in love with it. This typically happens when you're house hacking, where you're going to buy a multifamily property and you're going to live in one unit and rent out the other unit or 2 units, whatever, in the property. If it's turnkey and everything's fully done and renovated and you are starting to picture yourself living there and you get emotionally invested in it, you will lose sight of the fact that you still need it to make money. The rents may not cover your mortgage, your taxes, and your basic expenses. On top of that, it's going to be a long hold before you see any type of real significant equity appreciation in the property because it's already fully renovated and you're buying it at top dollar, top of the market prices. So it will typically take a longer time to see value build up in the form of equity in that property. And of course, if there is a market downturn and you're buying a luxury Class A property and your tenants can't afford it anymore and they move out, in a downturn market, it is very hard to find somebody who is going to come in and pay the market rate rents that you were just getting several months earlier. And that may affect how much you can really afford this property and its expenses. So keep that in mind and don't mislead yourself. The next type of property that you need to watch out for is the property with the atypical expenses. And what I mean by that are properties that maybe have a unique situation that requires extra and sometimes expensive insurance coverage, like flood insurance. Or perhaps they're properties in a jurisdiction that has very high taxes, and maybe 3 blocks over, the taxes drop tremendously because it's a different neighborhood, and therefore the rents are cheaper. The fact that it has such high taxes is why it looks like a steal of a deal on paper, because the rent roll is good and the price is cheap, but the taxes are part of your expenses and they are very high, just like the insurance is part of your expenses and it's very high. And I can tell you another type of property that falls into this category is one with outdated utilities. I actually recently saw a property that I was looking to invest in, and I'm here in the Northeast where it's very cold, and every unit had electric baseboard heating. And I know for a fact other buildings on that block have gas heating. Electric baseboard heating is outrageously expensive. So it's very hard to charge my tenants the same rent as the competing buildings on the block when their utility bills are going to be abnormally higher than everyone else up and down the street. The word will get out. People will know and say, hey, just be aware that building, baseboard heating, outrageously expensive in those cold winters that we have up here in the Northeast. So be aware of that because tenants don't want to pay that just like you don't want to pay it. And if the utilities aren't even separately metered and you're paying the cost of it, then it's going to be like 85 degrees in their apartments and you're going to be covering that sauna all winter long. Not good with electric baseboard heating. It's just another example of it. And that is why we negotiate due diligence clauses into our contracts so that we can have the time to go and fully vet these properties and understand what the real expenses are with insurance, with taxes, with utilities, and everything else. The fifth and final property that we want you to be cautious about is the property where the realtor does the numbers for you. And that is most properties, but you have to separate yourself from the realtor. The realtor's job is to show you some numbers that look great, get you emotionally invested, and get you to purchase the property at the highest price possible. The brokers make their money on commission, so the more you pay, the more they're going to receive. That's why we advocate that you really need to understand your target neighborhood. Walk it, know it, understand it. And then, once you've found the neighborhood that has the right fundamentals for long term growth, you're going to go and look to make sure you're buying the right property within that neighborhood by crunching the numbers and doing the comps on the purchase value, the after repair value, and again, the rental that you can expect to receive back, that rental expectation. We literally just did 2 videos about this that you should have seen already, but if you haven't, you should really check out. And I'll leave the links down below so you can check them out. You may want to watch them a second time, even if you've already seen them once. The first was about how to find that neighborhood and know you're buying in a neighborhood with the right fundamentals for the long term growth, and that you're not buying somewhere that's a little bit on shaky ground and people may leave in vast mass numbers and leave you with an empty property. The second video was about how to make those comparables and do them confidently so that you understand what you're buying and what you should be paying and what your equity value will be after the renovations and what you should expect in the rents back. So again, I'll leave the links for those two videos down below. And you know what? You might as well hit like on this video if you haven't done it yet. And you also might as well hit subscribe if you haven't done that yet either, because you're missing out on a lot of great information that we keep premiering every week. And make sure that you hit the notification bell so that you get an alert to tell you we've released a new video. It makes life easier. Most importantly, we want you to remember that there will always be another deal out there. I don't want you to get analysis paralysis and never pull the trigger. But at the same time, I don't want you to rush. I want you to do the right deal and not the rush deal. Were you saying it with me at this point? Because I keep saying it. It's like a tagline here. Do the right deal, not the rush deal, and take your time, especially if it's your first investment. I thank you again for taking the time to watch this video. I hope you really did get something out of it, and I'll see you next time right here on Confident Real Estate.